Hello, ladies and gentlemen. This is Ashwin Shetty, the fund manager for Natal Champs and Rising Champs portfolios at Marcellus. Happy to connect with you through this video format for sharing my views on the small cap space in general and for the Marcellus portfolios in particular.
What is our current outlook on the broader small and mid cap space?
Small and mid cap space has been one of the better performing asset class in the last 5 years. We did see some break in this performance in the second half of FY25, but we have again seen them coming back sharply in the last couple of months. Having said that, at the risk of sounding a bit unpopular compared to the current prevailing sentiments around this space, I see two big challenges. One is around the fundamentals and one is around the valuation. So as far as fundamentals is concerned, in line with the broader corporate earnings, which saw a sharp revival post-COVID, helped by the revival in consumption as well as in the government capex, the small and mid-cap companies also delivered sharp growth in the earnings. However, we've seen in the last 3 quarters these earnings witnessing a sharp deceleration. So if you look at BSE 500, the earnings growth, which used to be in double digit till FY24, it has come down to single digit in FY25. Moreover, in the small cap space, we have seen much sharper deceleration to the extent that we are seeing now the earnings declining YOY for the last 3 quarters. So clearly there are challenges around the fundamentals. One of the big reasons could be the slowdown in the consumption. Our macro team has written a lot of blogs and other stuff around the underlying drivers of this slowdown. So one big reason is that the households are saddled with debt and that is impacting their ability to consume. And second big challenge around this space is on the valuation. So contrary to the fundamental performance which I highlighted in the last 3 quarters, we have seen the valuation or the share price going up continuously. To the extent now we see the contribution as far as market cap of small cap companies within the BSE 500 is at one of the all-time high, whereas the fundamental contribution to the BSE 500 has remained more or less similar in the last 5 years. So clearly the valuation looks exorbitant at this point in time. So what could be the catalyst of a correction in this space? One big catalyst is that the continuous earning disappointment which we will see in this space, which will require the analysts to bring down their estimates. So as we see today, the analyst community is still building in healthy double-digit growth in their estimate for the space in FY26 and FY27. We see that clearly risk to those estimates. And as we see the downgrades in these estimates, we see that could be a catalyst for the share price correction in this space.
Based on this outlook, how are we positioning our small and mid cap portfolios?
Good news on both the fronts. So as far as fundamentals are concerned, we are seeing a strong revival in both the LCP and RGP earnings in the last 3 quarters. So for the latest reported quarter as well as that is the fourth quarter of FY25, we saw the earnings growth being in high teens for the Natal Champs as well as the Rising Giants portfolios. What is fueling this revival in the Natal Champs and Rising Giants portfolios are three things. So one is on the export front. We are clearly seeing a revival in the export numbers for most of our portfolio companies. Second is many of the portfolio changes that we made in the last 18 months. Those new stocks are seeing a very healthy earnings growth. And thirdly, some of the portfolio stocks, particularly those are exposed to rural areas, we are seeing a very resilient earnings performance of those set of stocks. In contrary to the overall mid-cap space, the Natal Champs and Rising Giants are seeing a revival in the fundamental performance. And similarly on the valuation front, as we stand today, both the Natal Champs and the Rising Giants portfolios or 1 year forward allocation weighted PE is around 15 to 20% discount to the long-term average. So on the valuation side also we are very reasonably well placed. The underlying reason for the valuation for both the portfolios being lower than the historical average is twofold. One is being very disciplined about the valuation, both at the time of entry as well as for the existing portfolio. Wherever we are seeing the run-up in the share prices are significantly higher than the underlying fundamentals, we are not shied away from trimming the positions in this stock or even exiting those stocks. Similarly, we have a bunch of stocks where we track actively. We have been very disciplined about the entry price for those stocks. Only when those stocks are coming within our desired IRR range, we are taking positions in those stocks. And the second reason for the valuation for the portfolio coming off is the increased allocation to cash. So as we have communicated in our earlier webinars as well as newsletters, over the course of last 18 months, we have been increasing the position in the cash in both the portfolios.
What are the key reasons behind the recent increase in cash positions across both portfolios?
The reason for increasing the cash allocation is purely the risk which I highlighted in the small and mid cap space. So we've seen in the past, whenever there has been correction in the broader small and mid cap space, even good quality stocks have seen correction. So as a result, if there is a sharp drawdown in the space, we foresee that some of the portfolio stocks that we hold could also see correction. And hence, an increased cash position will provide a mitigating factor towards this downfall. And the second reason for holding cash is that if there is a sharp downward correction in good quality stocks, whether it is the portfolio stocks that we own or the stocks that is under our coverage and we track actively, the cash will help us, will provide us the dry powder to buy those stocks or increase the position in those stocks. And as far as the returns of the portfolios are concerned, the rising giants have seen a sharp outperformance versus the BSE 500 in the last 12 months. Similarly, we also seen Retail Champs portfolio outperforming the benchmark BSE 500 for the last 12 months.